All right, let's talk about a strategy that could completely change how you think about buying stocks. Seriously, we're going to dive into how the pros get paid to buy the stocks they already want, often at a serious discount. It's time to stop just hoping for a dip and start taking control. Let's get into it.
Does this sound familiar? You find a company you absolutely love, but man, the stock is just taking off. So you wait. You set a price alert, maybe a limit order, and you just hope you can catch that falling knife at the perfect moment. It's stressful, right? It's a game of anxiety, and honestly, you often miss the boat entirely. But what if I told you there's a much, much better way?
Okay, look at this. This slide is the whole game right here. On the left, that's the old way. You're the hopeful buyer, you're passive, you're waiting, and you get paid exactly zero for your patience. But on the right, now you're a liquidity provider. You're proactive. You set your dream price, and here's the kicker. You get paid cash instantly just for being willing to wait. It's a total mindset shift.
So this first part is all about that fundamental change in your role. It's about flipping the script. You're going to move from being someone who just takes whatever price the market gives them to someone who sets the terms and gets paid in the process. So what is this magic tool? It's called a cash-secured put. And the definition really says it all. You are simply making a commitment to buy 100 shares of a company you already decided you want, but, and this is key, only if it drops to a price that you have selected. For making that simple promise, the market pays you an instant cash premium right into your account.
I absolutely love this quote because it just nails the feeling of the strategy. You're not chasing momentum anymore. You're not panic buying on green days. Instead, you figure out your value zone, the price where you'd be thrilled to own the company, and then you just sit back and collect rent from the market for your patience. It's incredible.
Okay, the philosophy sounds great, right? But how does it actually work? What are the nuts and bolts? Let's break it down right now, and I promise it's way simpler than it sounds.
There are really only three moving parts here. First, the cash-secured part. This just means you need enough cash in your account to actually buy 100 shares at the price you choose. That's your collateral. Second, the strike price. This is your number, your dream entry price for the stock. And third, the best part, the premium. This is the cash that gets dropped into your account the second you sell the put. Simple as that. Now, what's so powerful about this is how you can frame both outcomes as a win. So, scenario A, the stock stays above your price. Great. The option just expires, you keep 100% of the cash premium, and your collateral is freed up to do it all over again. Total win. But what if the stock drops below your strike? Well, for a smart investor, this is also a win. You get assigned the shares of a company you already decided you wanted to own. And check this out. Your actual cost is your strike price minus the premium you already got paid. You got a discount on your discount.
Okay, listen up, because this right here is the most important part of this entire explainer. The mechanics are easy to learn, but it's the philosophy that keeps you safe and turns this from a gamble into a professional strategy.
Let that sink in for a second. This is the golden rule. You have to think of yourself as a value investor first and an option seller second. The goal is always to buy a fantastic company at a great price. The premium? That's just an awesome bonus you get for being disciplined. It is not the reason you make the trade.
And this is the trap that catches almost every beginner. They see some crazy high-flying stock with a huge premium and their eyes light up. They get greedy. But you have to understand that huge premium is a warning sign. It's the market screaming that a massive price swing is coming. Chasing that premium is how you end up forced to buy an awful, overvalued company right as it's crashing. When you focus on valuation first, you adopt what I call the sleep well at night logic. I mean, think about it. Where's the stress? If the stock goes up, great. You made pure profit from the premium. If it goes down, great. You're just following through on a plan you already had, buying a company you love at your price. It completely removes the gambling impulse from investing. So, we've got the right mindset? Perfect. Now, how do we add some layers of protection to make this strategy as bulletproof as possible? Let's look at how the pros build a real safety net around their trades.
Think of this as your pre-flight checklist before every single trade. First, check the fundamental floor. Is the company actually cheap compared to its own history? Second, the happy to own test. Just ask yourself, would I be genuinely happy holding this company for 5 years if I get it? This kills that gambling impulse. And finally, strike selection. Be disciplined. Set your strike price at or even below what analysts think is fair value.
Now, here's a brilliant shortcut to managing risk. Just follow the smart money. By sticking to stocks that are core holdings for giants like BlackRock and Vanguard, You are basically outsourcing a ton of your research to the biggest, smartest teams of analysts on the planet.
And why is that such a big deal? Well, for 3 huge reasons. 1, these stocks have massive liquidity, meaning you'll never get stuck in a trade. 2, these big institutions demand professional governance, which drastically reduces your risk of fraud. And 3, you get structural stability. Think about it. Index funds are constantly buying these stocks, which creates a natural floor of demand that a lot of other companies just don't have.
Okay, so far, we've really focused on using this strategy to get into stocks. But believe it or not, that's only half the story. Now we get to see how this becomes the engine for a true, long-term cash flow machine.
This is the famous wheel strategy, and it's a beautiful, simple loop. Step 1 is what we've been talking about. You sell cash-secured puts and collect cash until you're finally assigned the shares you wanted. But it doesn't stop there. Once you own those 100 shares, you immediately start Step 2, selling covered calls against them, which is just an agreement to sell at a higher price to collect even more premium.
And that consistent stream of cash you're generating, that's called a synthetic dividend. This is such a powerful idea. You know, a lot of the best high-growth companies out there don't pay dividends. They reinvest everything. Well, this strategy lets you create your own dividend from those exact same companies.
And that's the magic. You're getting paid premium on 2 sides of the trade. You get paid to wait to buy the stock, and then you get paid to hold the stock. This is what turns a static portfolio into an active, humming cash flow machine.
And really, that's what this all boils down to. This isn't just a tactic, it's a whole philosophy. It's about making a choice. Are you going to keep being an investor who nervously chases price? Or are you going to become an owner who patiently collects value and gets paid for it? The choice is yours. Thanks for tuning in.